after going through everything that's happening around the world on the IMF side, we wanted to go deeper into what's happened so far within the US. So the real GDP growth obviously came in at negative 0.9. Just to give you an idea, GDP fell at a 0.9%, at negative 0.9% annual rate in Q2. So I know that there is a pushback in terms of, well, is this a recession? Is this not a recession? So technically, a lot of places will say 2 consecutive quarters of negative growth is what you need. The U.S. technically got rid of that definition. I think it was the 80s, but I'm gonna default to those that may know more. So I understand that it is very funny, the comments that have come out about the way the administration is approaching this. But to be clear, that there is some wiggle room within that. I think that as of right now, as we sit today, we are in a recession. As I've said before, I thought Q2 was going to have a little bit of growth, and we did get some of that. And so when you look at consumption rose by 1%. It was still small, but it was positive. So business fixed investment better than expected, negative, but a negative 0.1. Residential investment is what cratered the most, and then was actually negative 14%. And then the volatile factors, which as we talked about, our inventories, was down negative 2%. While net exports rose 1.4%. So again, there's some of that mix. So there's going to be nuance as to, and I guarantee you there's going to be economists. This is away from political affiliation. There will be economists that say there is enough here to declare a recession. And there will be economists that will say there is not enough here to declare a recession. So I'm going to say that I think based on consumption that we can say that we skirted it. But again, as we said before, we expected minute growth. It wasn't like we were expecting this gangbuster move. We expected to see small growth. Instead, we got some small decline of negative 0.9, which, and if you look at the estimates were for positive 0.5, so missed estimates by a wide margin. When, as we've said before, we were expecting 0.1, 0.2, like something very minor, and instead we got negative 0.9. So there's still pressure there, and then the Q1 GDP taken down to negative 1.6%. Labor market and consumption data might be strong enough to stave off the label. But when you look at consumption patterns as we go from June into July, they're negative. This is the conundrum that we come in, because you can say it's like, okay, well, technically we missed out on a recession in Q2, but when you look at Q3, we're officially in a recession. So my view is that since the second half of June, we've been in a recession. So I think there was enough growth when you look at as we go through January, February, March, a lot of slowdown. Then as we got into April and May were tough, and we're a little bit better. But then as you got out of May into June, things just fell off a cliff. And that's why I think that as we sit here, as you watch this, as of July 28th, 2022, we're in a recession. I am officially declaring it a recession. It's just, when does it start? And our view is that it started in the second half of June, which, if you wait just how the quarters, that may be enough. So again, I'm hesitant to say that, but when you look at some of the underlying problems of that number, then this is what we were talking about with consumption. So consumption was at 1%, small, flat, but look, it's starting to creep lower. And as we've been talking about those leading indicators, it's going to continue to go down as the price index, which is again that look at inflation, just at 8.7%. It's just blowing through estimates. So that is not and that was again carried by June, because June inflation went up based on crude, based on gasoline, diesel. Some of that is pared back, but again, there's still a lot of problems throughout the industry and throughout the supply chain, industrials, throughout the supply chain that are going to keep that up there. And then GDP personal consumption came in at 4.4%. And again, that's where it's coming down though. And this is looking at personal consumption core price. So one of the things that we're looking at is as consumption is coming down, prices are remaining elevated, and that's that value versus volume, where the value of what people are buying is going up, but the volume is actually going down. And we have a lot of charts on that where you're seeing that volume now really starting to bite, which is going to impact even the value side, which is again going to give way more into stagflation. As you even look at that GDP price index, it's starting to crest. And one of the things that we've been saying is that it's not that it's going to drop like a rock, but it's again going to flatline, giving way to what we've been talking about of stagflation. So spending in Q2, and if you want to think about how did the consumer do it, well, as we've been saying, for those that have been watching us throughout all of Q2, it's on credit. And so it's no surprise that credit card volumes jumped to a record in the second quarter. And that's why we now have the most credit outstanding ever in US history on the consumer side, on all sides. And if you remember during COVID, there was a big dip because people paid off their credit cards, and now that has completely reversed, and we are back to, we've now taken out the pre-COVID high, and we continue to add on to that. But as the pain mounts, the economy slows, you're going to see this pare back. But by doing that, because the cost of things have gone up, you're going to see the decline in volumes further. Now, this is all leading to, and investors no longer expect higher bond yields, but the trade was crowded. And that's why we still see yields going up. We still see bond pressure, especially even as things slow down, because as an economy slows, typically rates will come down or yield will come down. But at this point, because inflation is going to remain a problem, there's still some expectations or broad expectations that inflation is going to come under control in the next 12 months. And we continue to see that as just not something that we're expecting. Again, back to that stagflation side and those pressure points, which is going to keep yields elevated. Now, here are some different individuals. Goldman Sachs, Barclays do not see a recession. They are revising down their GDP forecast, but as you can see, they still expect there to be growth. We're not there. We still expect real GDP to go negative. Recession probabilities from Morgan Stanley is at 36%. So again, still low. And Goldman Sachs is very similar to Barclays, where they do not see they're not forecasting a negative GDP. And again, we disagree, especially because we think Q3 was going to be worse than Q2. And so far it is worse than Q2, and Q2 is negative. So to give you an idea of where that pressure is going to come in, that's why I think there's going to be way more write-downs and adjustment to some of these estimates, because again, these were also printed prior to the Q2 number, and I think that's going to shift some models here. But yet on the other side, recession is now a consensus, but it's a consensus amongst who or with whom is going to be the biggest concern in terms of how our money flow is going to change, because has some of this been priced in? Has some of it not been priced in specific areas? But when you look at M2 and how M2 growth has come down, again, as the Fed, the quantitative tightening remains, you see some of these key pieces. And one of a concern that I have on what isn't really appreciated is just the amount the Fed has been buying and the Fed purchasing that has been in place, where the Fed has been buying a significant amount of bonds over the last 2.5 years. And now that they're gone, who is the buyer? And yes, because of the strong dollar, because of inflation, you will get more buying from emerging markets and from, again, international players in general. But as they tighten, as they struggle, that's going to also create a problem, which is going to limit the amount they can buy, which as prices, and remember, price and yield are inverse. So as prices go down, because there's just less people buying, that's going to push yields higher, because you're going to try to attract more purchasing, which we think is going to put some pressure. But M2 growth, again, has been negative But the question has been, and again, this only goes back to 2013. When you go back to 2009 and you look at how M2 has continued to grow, obviously you had an exponential move back in 2020, the end of 2020, and then into 2021. But that drop is going to keep, or I should say, anchor inflation, which is why we don't see inflation just going parabolic again, staving off and going a bit sideways. But this is also going to lead, because a lot of the growth that we've seen was nominal. And now that you're pulling away, you're going to get a clear view of just how bad or how weak growth has really been. And so U.S. PPI remaining sticky. Expectation was for 10.7%, came in 11.3%. And then the Atlanta Fed sticky CPI, 3-month annualized, sitting at 7.5%. Now, these two key pieces with the PPI, which is yet to be passed through because that was looking at June. When we look at June into July and August, we continue to see the producer price index elevated, but sticky inflation. This is the thing that is not going to adjust quickly. This is where we're going to see a lot of this pressure, and it's going to keep the U.S. GDP fairly sticky on this downward trajectory, which I think is going to become a much bigger problem. So digging into the numbers, here you can see that consumer spend 0.3%, business investment was flat, residential investment was negative 3.7%, net trade exports were up 4.2%, with imports only up 0.8%. Remember, this is going to factor in the lockdowns from China, so imports did drop. Government spending continues to slow, as we've been talking about with that fiscal slowdown. So when we look at it, residential investment and government spending was the key driver lower, with consumer spending adding a positive component. So GDP, when we look at the simple rate, was negative 0.2. When you look at the what drove it, some of the key pieces are the non-durables, which was actually negative 1.4%. Durables was negative 0.6 on consumer spending, with services up 1%. And that's that pivot that we've been talking about, with physical goods continuing to come down, services remaining positive. But then fixed investment, we don't see getting better. Structures, equipment, again, continuing to get worse. Residential, another issue. Exports, imports are going to fluctuate, but based on where imports are right now and where exports have been fairly flat, that should remain a net positive. Government spending is going to continue to be negative. So again, a lot of reasons why we're going to continue to see this move through and move down, and what we see for Q3. The Fed funds future spread, this is just the view that they're going to start cutting rates next year. Again, that's something that we don't believe and that we don't think is going to happen, just given where inflation is and how sticky and how limited they've been in their addressing of it. And that's just another chart where the expected interest rate path implied by Treasury yields during the hiking cycle. Here's where you get an idea that as we go out into next year, you're going to get that cut, which is, again, something that we're not factoring in. And here's a key piece on why. So the Federal Reserve increased the Fed funds rate by 75 basis points, further tightening monetary policy, but with the upper bound of the target rate at 2.5%, the highest level since 2019. But when you look at just where inflation is and where the Fed target rate is, or the upper bound, if you will, we still see a lot of movement higher. Now, Powell came out very dovish yesterday in terms of saying we're going to be very data dependent. We're going to be looking at things more specifically. We're not going to give forward guidance the same way, because each meeting is going to be specific on the data. And just based on what we're seeing here, the data continues to point at more inflationary pressure, more issues into stagflation, which again is going to create, I think, more reasons for the Powell and the Fed to raise rates. And here's where you start looking at the implied Fed funds target rate based on the dot plots in terms of where they're going to be. And here you can see that the market, as we go into 2023 and 24, there's an expectation of rate cuts, where so far in terms of what the FOMC is saying, they still see rate hikes going into 23, and they don't see cuts happening until the back half of 23, really into 24, where when you look at the expectations out of the market, they're giving it a cut fairly soon. So again, we don't believe the market. We don't really believe the FOMC either. We think that is going to be a more gradual increase where maybe it won't be 75 basis points, but it will be something that'll be a bit more focused. So Powell's preferred yield curve indicator is now inverted, and this is what happens when you have a recession. So this is essentially telling you that it's a recession indicator. So it's saying that we're in one or one is imminent. And again, I think we're in one as we sit here today talking. So early in the year when the yield curve started to invert, Powell just made up a new indicator. They didn't make it up, but it's something where he just said this is more important than that one. So the 18-month forward, 3-month, so the 18-month forward 3-month yield versus the prevailing 3-month yield, it's only a matter of time, and here we are sitting at negative. And now when you look at real GDP and the underlying Atlanta Fed forecast, you can see that that was the biggest pull down, but weaker growth is in store. When you look at the growth tax, which is inflation, which is, again, all of these overhangs, that's going to pull that manufacturing down, which has already come in negative. Which is yet to come negative, but it's still 52. Services is already negative. So, we're assuming that the next reading will push that into contractionary territory. And as rates go up, it's no surprise to see that U.S. high-yield bonds, net issuance is negative. The spread between high-yield corporate bonds and U.S. Treasuries continuing to grow. Gross issuance of U.S. High-yield bonds is on a very low level. That's because of rates. That's because of volatility. That's because of lack of demand. And that's something that we continue to see playing out as credit risk and business risk remains the key drivers on the risk-off attitude. So if you think about high yield, typically there's more risk involved, there's more uncertainty, and there's credit risk behind that. And that's where we continue to see that there is an aversion to some of this riskiness. And that's where you would the financial market stability is deemed to be riskier, and that's where, again, if you're concerned, you're going to pare down risk, you're not going to add risk, which is that key piece. Now, when we look at some of the forward-looking pieces, U.S. business, excuse me. U.S. business activity contracts. Gauge of business activity shrank for the first time since 2020. Driven by services, as we said, U.S. services PMI came in contraction. Flash composite index slid 4.8 points to 47.5, weakest reading since May 2020. This is what we're talking about on why we're in a recession now, today, and these are some of those key readings. Another fun one, looking at housing in the last 50 years, whenever new homes for sale materially diverged from new homes sold, the end result was always a recession, and most of the time an ugly one. And if you look at the alligator mouth that has currently been created, you get an idea of why this is the case. July mortgage rate locks are down year over year, much more than today's pending sales, based on contracts signed, which means that sales closings have quite a bit further to fall. So when you look at new homes sold, you're going to get that going down even further, and we still see more upward pressure on new homes for sale. So we actually see this getting wider before we get that snapback. So again, just creating more pressure on the housing front, which we think is going to become a much bigger issue, which is why weekly leading index growth rate, again, negative. U.S. Beige Book strength minus weakness, economic diffusion, showing that negative skew. It's something that, again, we've been very adamant about and we continue to see as a big driver. Now, the probability of a recession 1 year ahead, according to the U.S. yield curve, and this is essentially putting us at a 93% certainty. Probability of being in a recession, according to the Conference Board Consumer Confidence Expectation Sub-Index, is at about 70%. So when you look at some of these indicators, again, these leading indicators, you're getting an idea that we're already here. And that's why even if they don't classify one as of Q2, that's still looking backwards. As we're looking today forward, we're already there, which is, I think, going to shape the way companies look at the world and the way the consumer does as well. Housing bubbles are vulnerable, especially when you look at how elevated real home prices continuing to be at this insane level, disposable income. So when you look at nominal versus real, we continue to see more of this coming down, and you're already seeing that. So pending home sales fell 8.6% from last month. This generally indicates a further drop in existing home sales growth, but NAR's pending index posted an increase for May, while existing home sales declined in June, which has happened 3 times in the past 36 months, but typically you have a snapback. And whenever it snaps back, it's in a negative way. So it just shows that there's more problems coming out, especially when you start looking at retail sales. So if you're a consumer, if you're a buyer, especially if you're looking to buy a home, you're looking at this and saying, okay, well, my wages are not going as far. So my retail sales have come down. When you look at inflation adjusted, again, value versus volume, volume is showing the decline, value still going up. But yet housing prices haven't really come down at all, but mortgage rates have gone up. So I'm doing nothing. And that's where, but it takes time because the homeowner is sitting there saying, well, I want to get the price that there was 6 months ago. Instead of appreciating, you have to get what the market can bear, and the market can't bear that price anymore. And that's some of the conflict that we're going to continue to see, which is why we're going to get a face-off between buyers and sellers, which is why we continue to see some of this degrading data as we go into really the end of peak home buying, which is typically viewed as we go into September, October. And then when you look at the conference board, consumer confidence continued, consumer expectations, again, going through a floor, present situation declining, but not too bad with the consumer confidence also. So consumer confidence index was down 2.7 points, present situation down 5.9 points, and expectations down 0.5. Concerned about inflation, less optimism about labor markets, and worried about a recession. So that is all pulling things lower, which is why the expectations are much worse. And that's why consumer confidence, again, moving down. And that's also shifting the way loans are being looked at within banks. So banks marked about $1.3 billion of losses in the second quarter on corporate debt commitments to have yet to be sold to investors. So there's a certain amount of bonds, again, that we're not seeing a lot of demand. And this is why we do expect to see bad debt expense going up. And that's bad debt expenses is what banks assume won't be paid back, or they'll get pennies on the dollar in terms of where things are on both the corporate side and the retail side or the consumer side. And that's going to be a bit of an overhang in terms of what is in the banking system. So write-off rates at the country's 5 largest credit card lenders dropped in Q2. But remember, a lot of new debt was put on in Q2. So this is something that we actually expect to flip, and we think things are going to get worse as we go into Q3 and beyond, as people continue to essentially benefit or live off of their credit cards. That's going to become an even bigger problem. Securities-based and based in other non-mortgage loans to wealth management clients has gone up, not surprising, as the wealth gap helping to drive that, especially as credit cards start to tighten the noose. And that's not going to show up until Q3 data, because when you look at staying current, that is not going to be an issue yet. And again, this is, I think, a lagging indicator. And the reason why we wanted to talk about it is because we see this as, and it's going to become, I think, a bigger problem, which is going to drive the recession lower. And the pressure is going to mount in Q3, and the consumption is going to go negative as this tightens. And this is going to become an overhang for a lot of these companies. 3 ways to look at job growth. So household survey adjusted to payroll, household survey establishment survey. Again, you're getting that it's moving in the wrong direction. Some of it is still positive, but then when you look at the positive wage growth would bolster consumer confidence. But when you look at real average earnings, you're having that moving down, and we don't see that adjusting higher. And that's going to keep some of those overhanging that weight. So not only are people concerned on the expectation side, they're also expecting jobs to not be as plentiful. Real wages won't go as far, which is going to keep consumer sentiment at the lows. We don't think it goes much lower, but it's, again, you're at the lowest it's been since the 80s. And the households, which includes, so again, those are the pressures that we continue to see. But non-defense capital goods shipments, so PPI private capital goods adjusted as is negative, capital shipments is still positive. So it's that divergence that we're seeing, and it's just a matter of who has inventory, who has supply chain issues still, and that's something that's going to be a bifurcation that we don't see going away quickly, creating some of that stagflation that we talked about, because we will get some deflation, some normalizing in other areas, but some either continuing inflation or stagflation in others, again, netting that out to the problems. So what consumers are doing to prepare for a potential recession: cutting back on spending is 62%, sticking to a budget 39%. What aspect of a potential recession worries consumers the most? Not being able to afford monthly bills. So again, as that filters through, which it is and has been when you look at retail sales, but as people then pull back on credit, that's when you're going to get the point, which is why we do think Q3 is the problem. Private label market share has continued to grow as people, again, trade down. Price premium relative to private label, Campbell's 60%, Mondelez 58%, Kellogg. So again, everyone is going down on that private side because they need food for their family, and spending up for Campbell's just doesn't make sense right now. And which is why but the question is, can Campbell's reduce prices? Do they need to? Do they issue more coupons? These are going to be some things that they do to try to compete against some of the private labels. But some of them, Campbell's also bottles, or I should say packages some of it. So at the same time, they still benefit in general. But that's a broader conversation. We're already 26 minutes in, so we don't want to belabor the point, but we will touch on that further in another episode. So year-over-year changes in reserve balance, you can see it continuing to go lower. Treasury market depth, which is just how much liquidity in the market, also falling. So as that happens, you're going to start to see some of this competition, which could keep yields a bit locked. But when you look at liquidity issues, reserve balance is coming down. So liquidity has been decreasing as the Fed reverses quantitative easing, which is a headwind for economic growth, but it's also gonna kind of hone in on and get those yields to stabilize. But again, we still see a lot of other inputs and other factors that is going to keep that volatility still in place a bit more than expectations. I thought this was an interesting chart. It just looks at price changes, and the ones that are highlighted are the ones that are subsidized or have government involvement. And I just think it's interesting to see that those are the ones that have the most increases in government involvement, and it has it's gotten the most expensive over the time period. Not to say that it's just because of government involvement, because some of these also are impacted by other things. So it's not, you can't just point and say this is all their fault, but it just is an interesting dynamic when you break it apart and you look at what government subsidies have done. I can support the fact that college tuition is 100% or very much so supported by government agencies, because you're essentially locking in money that has to be consumed in colleges. So you have this captive nut again, I just think that there's a lot that has to be done on that front. But that could be another hour conversation. Consumers failing to make ends meet continues to rise. Credit cards jumped to a record volume in Q2. This isn't a sign of consumer health, but rather consumers turning to credit to fill the void. I think this is a really good chart because it shows that this has been an ongoing problem since 2009, 2010. And we've been talking about this extensively, and why we think this is a real problem when you look at the health of the market, the health of the consumer, and other reasons why we don't think this is going to be a quick dip and then we're right back to growth. There are a lot of simmering problems, broken natured problems within the market that has to be fixed or rectified before we can get back to some meaningful growth, and not just nominal growth, but real GDP growth where there's actual benefit being passed down to the consumer or the laborer, which we just don't see. Consumer energy prices changed from a year ago. Gasoline, utility, electricity, food spot price versus food CPI. Again, food it continues to be a driver. Some foodstuffs have gotten better, but again, other issues remain. And then electricity continues to be a huge driver, which we don't see changing in any time soon, which is electricity going to continue to go up. Gasoline will come down, but again, it's not going to come down to a meaningful level. It's just going to come off the highs, while piped gas, especially when you look at natural gas, remaining elevated, keeping that electricity bid. Now, the composition of income varies with income level, not surprising as people rely more and more on wages and salaries as you go down. So as real wages fall, real salaries fall, that's where you get that bigger impact on income, and that's where you're going to see even more problems and that wage gap grow. Lowest year-to-date junk bond sales, as we said, going to continue. And then when you start looking at just change in credit availability, so when you look at it's harder and harder to get that credit versus a year ago, which is one of the key problems, which is what we talked about with, again, the consumer, the corporations, the ability to get some of that capacity, which I just don't think, again, which is why we're getting a very low loan growth, which is what we just wanted to reiterate again. Well, excuse me, when you look at high yield debt and just the inability to get it, because more and more companies are going distressed, and that's just based on the distressed nature, the high interest rates, you're not getting people coming back to market. So that's what we have for you here. In the next segment, we're going to look further into leading indicators and, more importantly at this point, housing and the issues that remain in the housing market.